Okay then. Well, thank you everyone for joining. My name is Phil Waddell, and I am one of the financial planners at Clarence Place Wealth Management. And what I really wanted to do today was just talk about a common subject that comes up when I speak with my clients and talk to people at events as well. And that is really what happens to your pension after death. Now, before we get started, I just want to explain a little bit about who we are. So, Clarence Place Wealth Management is a senior partner practice of St James's Place, and we're very much holistic financial planners focusing on our clients' goals and objectives. We really want to understand your current situation and what it is that you want to achieve in life, which allows us to put together a bespoke financial plan for you, which tells you what you need to do in order to hit your objectives. We can plan for individuals, families, businesses, trusts, and charities. And we cover four main areas. The first one being investments and savings. And this is anything from cash-based investments all the way up to some more complex venture capital trusts, enterprise investment schemes, and everything in between. We help our clients protect against risk. So this is really life cover, critical illness cover. We can even do home insurance as well. Retirement planning, exactly what it says on the tin, really making sure that you've got enough money to stop working when you want to and not when you can. And finally, we've got estate planning, which is around 30% of what we actually do in the practice. And this is really ensuring that we get money down the generations free from inheritance tax and making sure that the right money gets into the right hands at the right time. Now, before we get started, I think it's really important to just explain what pensions are. So they are a very tax efficient way of saving money for your retirement. You can put up to £60,000 in each year, depending on your earnings, and the government tops up your pension through tax relief. They're accessible from age 55, and that's rising to age 57 from 2028. And you can take your money as a form of an income, a lump sum, or a combination of both. Now, there are different types of pensions, and I'm just going to talk about the three main types that we see. The first one is a state pension, and this is an income for life, so long as you've contributed a minimum of 10 years worth of national insurance contributions, and this is paid to you through the government. The maximum amount you can get is after 35 years of contributions, and is currently £9,335 per year. Next, we have defined benefit pension schemes. These are commonly known as final salary schemes or career average. And these provide you with a guaranteed annual income for life based on your final or average salary. And typically, if you were to predecease your spouse, they would receive 50% of the benefit or income you were receiving for the rest of their life as well. And lastly, we have defined contribution schemes. Now, these are probably the most common pension schemes that we see. And the final value is based on how much you pay in and how well it has been invested. And I'm going to kind of concentrate on those defined contribution schemes today. So what happens to these pensions when you die? So let's have a look at that. So in this scenario, we have husband, wife, and kids. Husband has his own estate, and that is made up of pension, death in service, investments, ISAs, cash savings, and a share of the family home. And his estate is worth £750,000. The wife has her own estate. Again, she has her own pensions and savings, her share of the family house as well, and again is worth £750,000. Now, in this scenario, the husband dies and all of the assets move over to the surviving spouse's estate. And this is known as a mirror will arrangement. Everything moves over to the spouse and there is no inheritance tax or anything along this transfer. So what happens here is her estate grows to £1.5 million. Now, a bit later on, she passes away and the children move into their estate when they're older. But before they can get their hands on the estate money, unfortunately, the tax man wants a piece of the pie. But before they can get a piece of the pie, there's a few things that we need to work out. First and foremost, we need to understand the full estate value. In this scenario, we know that's £1.5 million. We then need to work out how many reliefs are available to the individuals. And first and foremost, everybody gets what's called a nil rate band, or an NRB for short. That's £325,000 per person, and again can be inherited by the surviving spouse in a marriage or a civil partnership, which is where we've got £650,000. And this is money that could be passed to anybody. It could go to your children, nieces, nephews, friends, brothers, sisters, whoever. And there is no inheritance tax to pay on that. Now, a few years ago, the government wanted to increase how much a married couple can pass down to their children to £1 million. And instead of doing the simple thing and increasing the nil rate band to £500,000 each, they've introduced what's called the residence nil rate band, or the RNRB for short. Now, this is £175,000 per person, and again can be inherited by the surviving spouse. But this is for your residential property being passed down to children or grandchildren. So it really has to stay in that linear family line. If you want to leave your home to nieces or nephews, unfortunately, you would lose that residence nil rate band, therefore reducing how much relief the government gives you to only £650,000. Now, what we know is we've got £1 million worth of reliefs, but we've got £500,000 over. Now, that £500,000 is susceptible to inheritance tax, which is at 40%. So in this scenario, that is a £200,000 tax bill, which means that £1.3 million is passed to the children. And so they have to give the taxman that money before they can realise the gains in the estate. Still a nice amount to be passed down, but we can do better. And what I want to talk to you about now is a solution that we have, that we present to all of our clients, that can really help save and make everything in this kind of transaction a lot more efficient, speed-wise and tax-wise as well. So the Legacy Preservation Trust, or the LPT for short, is our solution for this. And it is a trust specifically designed to receive lump sum death benefits from pension schemes and or death in service arrangements, and can help save hundreds of thousands through inheritance tax planning. So let's look at our existing scenario, but with the Legacy Preservation Trust in place. So again, we have husband, wife and children. £750,000 for him, £750,000 for her. And we don't like the husband because we kill him off again first. But instead of all of his assets moving over to the wife's estate, up pops a Legacy Preservation Trust, and you find the pensions and death in service benefits move into the trust, and the jointly owned assets, so cash, property, move over to the wife's estate. So what's happened here is £500,000 has moved into the trust, £250,000 has moved into the estate, bringing that up to £1 million. Now, let's say in this scenario, the surviving spouse was reliant on the late spouse's pension, and just because they've died and it's moved into the trust, that hasn't changed anything at all. Well, in the form of an interest-free loan, they can borrow as much or as little out of that trust as they need. She could take all of the money, get on the next flight to Saint-Tropez and live the rest of her life out on a yacht. Or she could just carry on maintaining her level of lifestyle. And that's what she's been doing in this scenario. Now, a bit later on, she passes away. And if it's possible, the money that's been borrowed in the form of this loan needs to be paid back into the trust. And in this scenario, it can. If there isn't options available to pay into the trust, it's simply less money in the trust to be passed down to the beneficiaries. And then the children move into the estate when they're older. Now, again, how is this all tallied up? So first and foremost, we need to work out how much money there is, and we know that's £1.5 million. We also need to work out, again, how much relief is available from the government. And we know we've got £1 million in total with the combined nil rate band and residence nil rate band. The only difference in this scenario is where we've structured the money. So we have £500,000 in the trust and £1 million in the estate. Now, the amount that's in the estate matches the amount of relief that is available to you, which means there is no inheritance tax to pay because the money in the trust is sheltered from inheritance tax. It's not included in any of their taxation or any of their calculations. Imagine it as a complete separate entity, which sole purpose is to pay beneficiaries, but isn't included in any estate calculations. So what happens here is the full £1.5 million is passed to the children, which is a total tax saving in this scenario of £200,000. Now, not only does it help you in terms of tax efficiency and give the maximum amount of inheritance to the people that you care about and want to receive your money, there are actually a few other benefits that are associated with this. First and foremost, there is no cost to set this up if you were to go through us. If you were to use a solicitor, it's going to cost you in the region of £500 to £1,500, depending on the calibre of solicitor that you use for. Our job is to financially plan for our clients. And as you can see from the previous slide, this is a real proper bit of financial planning. And it's why we feel so strongly about it within Clarence Place. There are no tax implications until you pass away. So this trust, once we set it up, it just lays dormant behind the scenes and does absolutely nothing. And it will only come into play if we decide at the point of death it's the right thing to set up. If it's not, we can simply rip it up and pretend it didn't exist. And that leads me nicely on to the next part. It's flexible. So if you choose some trustees, some beneficiaries today, and you want to change your mind in 10 years' time, that's not a problem. You can change it as many times in your lifetime as you like. You could, in theory, change it every week if you wanted to, although I'm sure we'd stop answering the phone to you for all the extra paperwork you want to give us. But it really means that it's not set in stone. Because the money's in the trust and it is this separate entity, it's not included for means testing for long-term care. So let's imagine in our scenario, the surviving spouse fell ill and needed to go into care. Local councils will do a means test. So they'll start adding up everything in your estate. And if it's over a certain amount of value, they will start reducing how much financial aid they'll give you to care. And they can start forcing you to sell assets, homes, and things like that in order to pay for this care. But they can't include the money in the trust. So it gives the beneficiaries the choice whether or not they want to use it for care or maximise it for inheritance, which I believe is a very good choice to have. It can also prevent spouses or partners from passing on the money to others who you may not want to benefit. So this would be second marriages, children in second marriages. We've all heard of horror stories about wealth getting diluted through these sorts of means. And again, it just adds that extra layer of protection and control, so you can control where the money goes to when you're no longer here. Also, monies left in the trust would also be protected from any claim made against beneficiaries by any creditors. So let's imagine this. The two children in our scenario decided to set up a business. Unfortunately, we know a number of businesses don't survive in the first 1 or 2 years. And they've set up this business and they've accrued a little bit of debt. Well, as long as the money's in the trust, it cannot be claimed by those creditors. So again, you're adding that layer of protection in there to maximise the beneficiary's benefit and financial gain from all of this. Now, I'd like to open the floor to any questions to see if you've got, if you want to know anything else about this solution or what could happen to your pension when you die. So please feel free to ask any questions if you have any. So we've had a couple of questions come in. The first one from Matthew. You said it was flexible. What does this mean? So what I mean by the flexibility of this trust is essentially the options to be able to change who is going to be your trustee, i.e. who's going to control how your desired beneficiaries receive the money, and who is one of your beneficiaries. So, for example, we set one of these trusts up for one of our clients about 5 years ago now. They had their children as sole beneficiaries. Since then, their now got grandchildren, and they want to be able to leave some money to their grandchildren as well. So what we essentially done is we've just added the grandchildren into the trust, and we've changed the percentage that the beneficiaries would get. So instead of 50% going to child one and child two, we've now split it to 25% each. So child one and child two get it, and grandchild one and grandchild two get 25% as well. I hope that answered the question there, Matthew. And Chris has asked another question about the annual cost of the trust. Quite simply, there is not an annual cost for the trust. If the money is invested, there may be some annual management fees to do with the investment side of things, but there is no administration cost when setting up that trust or to keep it running from there. The first kind of charge that you may see within the trust is you may have a periodic tax charge, which is from 10 years on from the date money goes into the trust, and that is 6% of the total value in the trust. Another question there from Lauren. Can I place my workplace pension and SIPP into one of these trusts? Well, I have seen hundreds of pensions throughout my years of advising clients. I've only came across one pension that wouldn't allow payment into trust. The majority of schemes will allow external schemes to be paid into this trust. And again, what we have to do in that scenario is just send off what's known as an expression of wish form over to the pension provider and trustees, and they can arrange for payment to go into it that way. Any other questions at all? Okay, perfect. Well, thank you so much for joining, everybody. On the screen now, you can see my details. So if you have any other questions, please feel free to send me an email. You can call our office or my mobile there, and we'll be happy to help and answer any questions that you may have. And also at the bottom there, you can see a QR code. So if you do want to set up a quick introduction call with me, and we can run through this in more detail or talk about some of the personal scenarios and questions that you might have that you may not wanted to have shared during this webinar, please feel free to do so. It will show you all the available slots in my diary. So please pick one that's convenient to you, and we can catch up and talk about all of the questions that you may have. Well, thank you so much, everyone, for joining. I really hope you found this to be useful. And like I said, we're always here on hand to answer any questions that you may have, no matter how big or how small. So I do hope you found today useful. And if you know anyone that this might be of benefit to, please feel free to let them know. I'll be following up in the next few days with a PDF copy of the slide deck and our practice brochure as well. So please feel free to share that with anyone who you may think would benefit from setting up one of these trusts, or who's got any questions about any financial matters at all. Thank you very much, everyone. I hope you enjoy the rest of your evening, and I look forward to speaking to you all soon. Thank you. Bye-bye.